Dan Lacalle joins us, Chief Economist at Treasury Gestion. Dan, lovely to catch up with you once again. If you don't mind, can I just start with your view on markets? Because I know you're positive US equities, negative European debt. Why?
Well, I think that what dominates markets right now is the perception that things are going to go very badly in terms of the economy and because of geopolitical tensions. And obviously, the increase in inflation adds to that risk. In my opinion, what I think is that we're likely to move into a second phase from April probably onwards, in which what we will see is a significant slowdown, but not in an aggressive recession, and at the same time, an environment in which all of these much hyped rate hikes cannot happen because of the relevant level of slowdown that we're seeing both in the United States and the Eurozone economies, but also because the impact of inflationary pressures on growth and jobs is likely to be significant. That leads us to take action and be positive on US equities, taking opportunities right now and reducing exposure to the maximum in Eurozone debt.
Then that when we look at the Treasury curve in the United States, the fact that we've seen the curve rapidly declining, maybe pointing to slowing economic growth and peak inflation, do you think that the Fed will look at that very closely then and back away from maybe the 7 hikes that Goldman Sachs has been pricing in?
Yes, I think that the Fed has given numerous indications and hints in their messages that they will review what is going on the economy to see whether they implement those rate hikes. I think that the number of rate hikes that the market has discounted are way too high considering the slowdown in the economy. And I think also that the yield curve is, in my opinion, actually, it's discounting more the fact that the Fed is likely to continue to be extremely accommodative rather than anything really significant about inflationary pressures or even less so deflationary pressures. I think that the inflation impact that we're seeing in food prices, particularly, I think, and on energy prices is likely to be more persistent than what many would like.
Dan, what does that all mean for the ECB and your take on their stance? And I wonder to what extent you think the ECB can protect European financial markets from a transmission of higher rates stateside?
Yeah. I think that that's a very good question as well, because what we're seeing in the Eurozone is that the markets do not necessarily respond to the messages that the ECB is providing relative to inflation and relative to rate hikes, but rather what is going on in the United States, which shows how the interconnection between the US and the European market is very significant. I think that the ECB is caught between a rock and a hard place, because if they increase rates, we have too many European governments, Eurozone governments, that have very elevated deficits and that have already seen spreads rise beyond what would be a comfort level for many of them. And if they don't hike rates, they basically are facing the threat of more elevated inflationary pressures, which are not as easy to absorb as in the United States, because in the Eurozone, the aging population has suffered a lot more inflation than, for example, in the United States, where wage growth at least exists in some level, at least in nominal terms.
On that point around wage pressure, I mean, President Lagarde was really clear in the last policy press conference that the wage pressure you're seeing in the U.S. and the U.K. just isn't present in Europe. It sounds like you are on board with the ECB's assessment of the labor market, and do you see that changing anytime soon?
Yes, the improvement of the labor market in the Eurozone is much slower than in the UK or the US. If you look at the level of unemployment in the Eurozone, it's about 7%, but you have to include all of the furloughed jobs that continue to exist in the Eurozone. And that's why you're not seeing wage pressure. That's why you're not seeing the kind of tightness in some of the sectors that we are seeing, for example, in the United States. So the labor market weakness is an important driver of the ECB's decisions, even if it's not directly in its mandate. And the ECB's decision is also likely to include in their latest revision the impact of on growth, of the Ukraine crisis. The energy crisis in the Eurozone is likely to shed in our numbers about 1% of GDP estimates.
Dan, really interesting thoughts there. It's always a pleasure to speak with you. Dan Lacalle, Chief Economist at Tressis Gestion.